Let's get ready to mortgage. He is the prince of programs, guru of guidelines, master of matrices. He puts the fun in funding. Please welcome Mark, Mr. Mortgage, Eitel.
All right. Hey guys, it's Mark Eitel here, and you are listening to the Mr. Mortgage Show. And man, oh man, I am so excited to be with you today. I am highly caffeinated, super motivated, public school educated, and ready to rock and roll. Guys, you are in for an awesome show this week. There were several data sets released, reports released around foreclosures, around interest rates, around demand. We've got the great rate debate going on in the news. Will 8% finally kill the housing market? Guys, we are going to dive into all of that and so much more. We're going to get your questions and comments on the air. If you want to participate, shoot your questions over via text or give Jen a call on the Anytime hotline. That number is 855-462-7292. That's 855-462-7292. That is the Anytime hotline, and Jen is womanning the hotline. She'll get your questions on the air. If you prefer to do it via the web, just head over to mrmortgageradio.com. That's mrmortgageradio.com. Click that big orange button that says get your questions on the air. Follow the instructions. They'll pop right up on Jen's screen, and she will read them on the air for you. Again, 855-462-7292 or mrmortgageradio.com. All right, guys, we encourage your questions and participation. But with that out of the way, let's dive right in. Man, the headline writers, these guys are amazing. They can scare the heck out of anybody. And this week was no different. We saw the economic data released around consumer spending, and inflation is still sticking around and likely to be here for a while. The Fed has indicated, or at least postured, that there's no easing anytime soon. No matter what the rest of us think, they're driving the boat, and they're pretty hell-bent on getting inflation down around that 2% mark, and there's no reason to believe that that's going to change anytime soon. So if the data that came out this week is any indication, there most likely is at very least a holding pattern in our future, but may even see another rate increase before the year's out. And I know nobody wants to hear that going into the holiday season, but deck the halls with higher interest rates. Oh, no. Maybe that's coming, guys. We're watching that carefully, but you can't argue with the data. The path is in the math. And right now, inflation is sticking around. So we'll see. He's swinging his sword at inflation, and it's just he's not chopping it down yet. So that's where we are with that. Foreclosure data, I want to dive into that because a lot of people, especially if you're listeners of the show, you grasp the concept of how supply and demand is the only thing that dictates the price of something, not the cost of capital. And I know at the beginning of this rate increase environment that we've been in for the last 18 months or so, people thought I was nuts. I mean, I've had arguments on podcasts with very smart people who told me I was crazy. As rates continued to march up, home values were going to come down, and we just haven't seen that yet, guys. There's not enough supply to outpace the demand in the market, although we are seeing supply tick up a bit. And as I mentioned, the great debate right now is, will 8% finally kill demand, or at least knock it down to the point that we see a slip in housing values? So that's going to be an interesting battle, right? The 8% interest rate versus demand. But I'm seeing people who are very, very serious about making moves in this market and still winning, interest rate buy down, seller contributions. And we can talk about that. But guys, a lot of people believe all these foreclosures are going to come to the market, and that's where the supply that is necessary to push prices down is going to come from. And too many people are flashing back to the housing bubble as their most recent point of reference. And we've talked about this too. It's a very different environment. And sadly, I still have PSTD. I lived through that in this industry, and it was ugly. But we had artificial demand. We had pent up supply during that time period. And what do I mean by that? We had people who had no business owning multiple properties. They weren't investing in properties with the intent to rent them out, maintain them, increase their value, reduce their principal, and over time profit from them monthly in a cash flow situation, and then sell them at a profit or 1031 parlay them into other properties. That wasn't the investor of the early 2000 housing bubble. It was anybody with a half decent credit score who knew how to game the system with stated income, stated asset loans with 100%, 103, 107. I even remember a 115% LTV loan that was floated in the market for a short period of time. You could finance your closing costs, and you could buy up to 10 properties. And people did that. People were closing on multiple properties in the same neighborhood and committing mortgage fraud with occupancy fraud, saying all of those were their primaries. And guess what, guys? They had no skin in the game. And when it came time to sell and times got difficult, they had 10 properties for sale. Well, there was no one person who wanted to buy 10 properties. This time around, we're only seeing a 1-to-1 ratio by and large across the market. People are buying their primary residence. We have artificially low supply because people are locked into their homes with these low interest rates. They don't want to sell. They don't want to sell into this higher interest rate environment. And we've got pent up demand because people want to own homes. So it's completely, the principles are completely the opposite, although the appreciation cycle feels the same. But that's not where I'm going with this. Back to foreclosures. A lot of people think that's going to save the day. So I saw this data released this week that said foreclosures soar to pre-pandemic levels. Well, guys, on the surface, that sounds scary, right? Pre-pandemic levels. What was a pre-pandemic level? So we looked at it. Man, foreclosures were historically low. The economy was great. People were working. Interest rates were lower. Gas was lower. People were excited, financially feeling good. We weren't in a distressed real estate environment pre-pandemic. So referencing that, it's irrelevant. It's just meant to scare you with this headline. So pre-pandemic level foreclosures, we're just normalizing. And we're normalizing to historically low rates. And here's what I wanted to point out. In this data, and I'll post this to the Facebook group, and you can read it for yourself at mrmortgageradio.com. Click on the Facebook link. It'll be there. It took 778 days on average from start to finish for a foreclosure in this data set. Guys, that's 2 years or better. This is just foreclosures working its way through the system. And as far as new filings, which are up 18% year over year, being the end-all be-all that floods all of this inventory to the market, think about that, guys. It's going to be 2 years on average before that inventory hits the market. So there's not a wave of supply coming. And I found this fascinating, and we could talk about it this week if you want. But diving a little bit deeper in this data, the longest it takes on average to get through a foreclosure is in, where is it? States with the longest average foreclosure timeline, foreclosed in Q3 of 2023, Louisiana, 3,045 days. Man, that's a third of a mortgage practically. That's nuts to me that it takes 3,000 days on average to get through foreclosure in Louisiana. Hawaii was 2,400. New York was 1,900 days. Nevada was 16, and New Jersey 1621. And Texas was the fastest. For some reason, that didn't surprise me because don't mess with Texas. They don't play around. Texas will get you through foreclosure in 160 days. So, guys, my point in all that is until more supply comes to the market, it's very, very likely that housing values are going to stay put or continue to rise at this slower pace. So no knights in shining armor riding this foreclosure wave in to rescue housing prices anytime soon. But guys, you hear the music, you know what that means. That's my cue. We'll be back in a few. Sit tight on the other side of this short break. We'll be back with more of the Mr. Mortgage Show. Hey, it's Mark Eitel, host of the Mr. Mortgage Show, and I'm going to interrupt this commercial break to ask you for a favor. If you know any friends, family, coworkers, or the guy in front of you at the grocery line who's talking or thinking about buying or selling or refinancing real estate, I'm hoping I can count on you to help me spread the word, introduce them to me, to the team. You can do that by simply sharing MrMortgageRadio.com. That's MrMortgageRadio.com. Guys, it's Mark Eitel, NMLS 1929005. Now, back to the commercials.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and this is the Mr. Mortgage Show. Guys, thanks for spending a bit of your day with us. We greatly appreciate your time. Always love doing the show for you. If you've got questions or comments along the way, please call or text 855-462-7292. That's 855-462-7292. That is the Anytime Hotline, and Jen is standing by, womanning the hotline. You can call or text your questions to her, and she'll read them on the air for you. Or head over to MrMortgageRadio.com. That's MrMortgageRadio.com. Right in the middle of the page is a big orange button that says Get Your Questions on the Air. If you click that, you can follow the instructions. They'll pop up on Jen's screen and she'll read your questions on the air. But man, oh man, thanks for letting me throw all of that at you with foreclosure data that we opened the show with. Guys, my point in all of that was there's not a rush of foreclosures coming to the market. Yes, we're seeing an uptick. My personal belief is a lot of this is moratorium workout stuff. I still believe we're at historically low foreclosure levels, and I think the data supports that. And because of that, I don't see a supply glut coming to the market that's going to push prices down. And let's face it, guys, there is such a large percentage of the population of homeowners who are they're not going anywhere anytime soon. They scored the all-time lifetime low interest rate, and they are going to learn to love their home through thick and thin because of it. I've got a friend who's a general contractor, and he's doing big home renovation projects right and left because people have a load of equity, a super low interest rate, and they're tapping equity lines and second mortgages to put additions on, to build guest house, big swimming pools, because they're just not going to move. They're going to make that their forever home because they're in love with their forever loan on that. Ooh, I like that. Hey, Jen, write that down. I've got to do something with that. Your forever home and your forever loan. Anyway, guys, let me throw it over to Jen. We'll get your questions on the air. I will take my pontification hat off and do my very best to answer your questions. Hey, Jen, go ahead and throw me a question.
Patricia sent this. We have an offer to buy our house, but they want to assume our mortgage. They said all we have to do is sign the deed to them, and they take over the mortgage. This seems pretty easy. Is there any more to it?
Hey, Patricia. Yeah, there's a lot more to it. So they're not going to assume your mortgage. What you just described is called subject to. They want to buy your house, leave the mortgage in your name. You quit claim deed the property to them, so you no longer own the property, the asset, right? But all the mortgage is still in your name. So while you do not own the asset, you are still wholly responsible for the debt. That's not a mortgage assumption, and a lot of people get that confused. I can't tell you how many real estate agents don't even understand the difference. That's not a mortgage assumption, Patricia. That's buying a property subject to, and you are the only one that's at financial risk in that equation. Because what if they don't make the mortgage payment? Then you're going through the foreclosure. Your credit is getting nicked. So that's not an assumption. An assumption would be they call your servicer, and your servicer is the company that you make your mortgage payment to. That's the mortgage servicer. The servicer has an assumption department. The buyer applies for a mortgage assumption through the servicer. They've got to qualify, and the servicer determines that their credit meets the qualifications, and they will essentially transfer the loan from you, releasing you of all liability, of all future risk, and put the loan in the new person's name. That is an assumption, and not all loans are assumable. FHA loans, VA loans, and USDA loans are traditionally assumable. And fun fact, guys, you can assume a VA loan even if you're not a veteran. But that's the process of a loan assumption. What you just described to me is, hey, I'm going to give you a down payment, you deed your property to me, and I'll make your mortgage payment for you. That's subject to buying a property subject to the existing mortgage. And not only does that put you at risk, it violates the due on sale clause. Almost all mortgages have a due on sale clause. And that clause states that if ownership transfers, that mortgage is due in full. So it could trigger the lender calling that loan due, and they're going to call you because it's in your name. So for many, many reasons, that's not the best option unless you are totally out of options. You're going into foreclosure and you have no other choice but to roll the dice and take a chance. And even then, it's still not something that I would ever recommend because of the due on sale clause. And I know there are investors out there that are screaming at the radio saying, we do it all the time and nobody ever calls about the due on sale. You can go 70 down the highway for 100 days in a row, and one day you're going to get a ticket. So be cautious. If you want to walk through that in detail, give me a call off the air. I would be happy to discuss it in greater detail with you. And thank you for the call. Hey, Jen, can we get another question in?
Lori sent an email. We own our main home and a beach condo. We plan to Airbnb the condo, but have to wait 1 more year. Money's getting tight, and I'd like to take an equity line on the condo so we have some money to get through this patch. Is the HELOC on the condo the best way to go?
Whoa, okay. So the condo's the second home, and I'm guessing you're waiting a year before you Airbnb it because the association most likely doesn't allow rentals for a period of time. And that's not uncommon. If you're going to buy a property with the intent to rent it, you need to check in the homeowners association docs if it's possible. Some neighborhoods, it's 12 months. I'm in the middle of a transaction now, and the docs don't allow rentals for the first 36 months. So first of all, an equity line on an investment property or second home is an option. They are available, although they're becoming fewer and further in between as the market tightens. But if cash flow is the problem, debt is rarely the solution, right? You said times are tough, things are getting skinny. Then adding more debt to the equation is rarely the solution. I'll be happy to discuss it with you if you'd like. On the surface, I'm not sure that it's going to be doable, and I don't even know if it makes the most sense for you financially. It might be the hard reality of selling the beach house, but that's a personal decision for you. To answer your question, there are equity loans available on second homes and investment properties. Again, they're a little more difficult to find, but my only words of wisdom, is debt the solution at this point? Because you're just adding another monthly payment to the equation. But I greatly appreciate the question, and I'm happy to help any way that I can. Hey guys, you hear the music? You know what that means? That's my cue. We'll be back in a few. Sit tight on the other side of this very short break. We'll be back with more of the Mr. Mortgage Show. Hey, it's Mark Eitel, host of the Mr. Mortgage Show, and I'm going to interrupt this commercial break to ask you for a favor. If you know any friends, family, coworkers, or the guy in front of you at the grocery line who's talking or thinking about buying or selling or refinancing real estate, I'm hoping I can count on you to help me spread the word, introduce them to me, to the team. You can do that by simply sharing MrMortgageRadio.com. That's MrMortgageRadio.com. Guys, it's Mark Eitel, NMLS 1929005. Now, back to the commercials.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and this is the Mr. Mortgage Show. Guys, if you have questions or comments, just call or text 855-462-7292. That's 855-462-7292. That is the Anytime Hotline. That's how you get your questions on the air. Just call or text that number, 855-462-7292, or head over to MrMortgageRadio.com. That's MrMortgageRadio.com, and click that big orange button that says Get Your Questions on the Air. Type it in there, follow the instructions, and Jen will read your questions on the air. But speaking of Jen and your questions, let's keep them coming. Hey, Jen, throw me another question.
Billy sent this text. I want to start flipping properties. Where are the best places to find foreclosures?
Hey, Billy, not deterred by that opening segment, I see. You are going to be a foreclosure hunter. Hey, that would be an awesome HGTV show, Foreclosure Hunters, where Billy goes out and finds properties to flip. I would watch that. Who would watch that? I know people would tune in for that. Hey, Billy, great question, my man. If you're looking at HUD foreclosures, which are FHA foreclosures, you would go to HUD, H-U-D, homestore.com. That's where the HUD inventory is liquidated to the public. And it's done based in groups, right? They'll first assign a property to a group that's only being released to people who are going to live in the property, buy it as their primary. And then the longer that it's on the market, they'll release it to larger and larger groups of potential investors. So HUDHomestore.com is a great place to start. Auction.com is another one. Auction.com liquidates a lot of the conventional mortgage foreclosures. But if you want to get a head start on everybody who is just searching the sites, go to your county's website, Clerk of Court's website, and search for lists pendens filed by mortgage companies. Lists pendens, 2 words, L-I-S-P-E-N-D, I think it's I-S, pendens, E-S, pendens, list pendens. I think the direct Latin translation is lawsuit coming. It's the document that's filed before everything else to let everyone know that there is a lien or an action that's going to be taken against that property. So the very first step in a foreclosure process is that list pendens. And if you go and do that research, you're ahead of everybody. You're in that 778-day cycle before the rest of the world even knows that that foreclosure is coming to the market. And with that information, you could either call or send letters or go, if you're feeling daring enough and you're being filmed by that HGTV crew, go knock on the door. Just see if the people are interested in selling before the house goes through the foreclosure process. A lot of times people are just embarrassed and they don't know what their options are. And if you can, get them early enough in the cycle, you too may be able to strike a deal that's great for everyone. So search the local county clerk of courts for list pendens or hit those other websites. But great question. If you need some more information, just shoot me an email. I'll help any way I can. I was a foreclosure hunter back in the day, so maybe I can give you some words of wisdom or at least some things to be cautious of. Okay, Jen, throw me another question.
Joanne has this one. This may be a dumb question, but what's the difference between a second mortgage and an equity line? There's no such thing as dumb questions.
That's true. No dumb questions. So an equity line is a second mortgage. It's a lien behind the first mortgage. The equity line is like a credit line. If you need some money, you can borrow against it. You can pay it back. It's there if you need it again. You can borrow against it. Where a traditional second mortgage is one lump sum of money. And you can get a first and second combo when you buy a property. You can get a first and an equity line combo when you buy a property. But most people's questions around second mortgages at this stage of the game are cash out seconds. And how that would work in relation to an equity line is you would close that second mortgage. It takes a second lien position behind your current mortgage. You get a lump sum of cash and you're paying it back just like your first mortgage. It's just another payment. And they could be 15 years, 20 years, 25. There are some 30-year second mortgages, and you just keep paying until it's paid off. So one is a closed end, take the money one time, and the other is an open end, and you can draw against it, pay it back, draw against it again, and use it kind of like a credit card, if you will, that's collateralized by the equity in your home. So I hope that helps. That's a good question, though. Thank you for that one. Hey, Jen, do we have time for another? Go ahead.
Eric used the website. I'm ready to start buying rental property. What are the pros and cons of buying a duplex versus a regular house?
Hey, that's a great question. And thanks for using the website. There's not a lot of difference. Some people think a single family residential property is easier to resell when the time comes. So some people will tick the box that that's a pro. A lot of people like the duplex because it's 2 income sources. A triplex would be 3 and a quad would be 4 under typically one roof, one set of exterior walls to maintain. So they like the idea that there's multiple streams with less cost per square foot to maintain it. That could be a plus in the multiple family side of things. The mortgage loans are pretty similar for buying investment property with either a single family residence up to a 4-unit property. So there's not a lot of difference there. But great question. If there's something specific that you are curious about, just shoot me an email and or call me off the air and I'll be happy to discuss it with you. They're very, very similar in the loan product. Maybe reselling a single family residence might be a little bit easier, but who knows? A lot of people are house hacking and buying that multi-door property as a primary also, which you can do, guys. You can buy a 1 to 4 unit as a primary residence with an FHA loan with as little as 3.5% down, and new rule change coming into effect later in November with as little as 5% down on conventional financing. So certainly leveling the playing field when it comes to that. But great question. Hey, Jen, throw me another.
Doug emailed this. I've heard that if I write a contract with an FHA buyer and the appraisal is low, I'm stuck with that appraisal if someone tries to buy it later. Is this true?
So, Doug, this is a great question, my man. I'm so glad you asked this because with where rates are right now, FHA rates are considerably lower and people are leaning on that product right now. So people need to be aware of this. If an FHA buyer goes under contract and for whatever reason falls out of contract, but they had the appraisal done, that appraisal does live with your property for as little as 90 days, as long as 6 months. That's true, but that's only for another FHA buyer. If it's a conventional buyer, that FHA appraisal is irrelevant. It's only assigned within the FHA underwriting system. So a conventional lender is never going to see it. They're never going to look for it. It's irrelevant. The same applies for a VA loan. And this is where people get super confused. They treat the VA appraisal and the FHA appraisal as the same set of rules. But the VA appraisal lives with the veteran. It's attached to the veteran. So if they fall out of contract and another veteran puts a contract on your property, that first VA appraisal is nowhere in the system. That is a huge misconception. You're right in the context that it will affect the next FHA buyer, but it won't affect a conventional buyer nor a VA buyer. And that's true if a conventional or a VA transaction falls apart, the next conventional or the next VA transaction, that first appraisal is also irrelevant. So great question. I hope I didn't confuse you. If you need more info, just reach out. That was a good one. We get that one a lot. Hey guys, you hear the music? You know what that means? That is my cue. We'll be back in a few. Sit tight on the other side of this very short break. We'll be back with more of the Mr. Mortgage Show. Hey, it's Mark Eitel, host of the Mr. Mortgage Show, and I'm going to interrupt this commercial break to ask you for a favor. If you know any friends, family, coworkers, or the guy in front of you at the grocery line who's talking or thinking about buying or selling or refinancing real estate, I'm hoping I can count on you to help me spread the word, introduce them to me, to the team. You can do that by simply sharing MrMortgageRadio.com. That's MrMortgageRadio.com. Guys, it's Mark Eitel, NMLS 1929005. Now, back to the commercials.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right. My name is Mark Eitel, and this is the Mr. Mortgage Show. Guys, you heard the man, 855-462-7292. That is the Anytime hotline. You can call or text that number, 855-462-7292. Or head over to MrMortgageRadio.com. That's MrMortgageRadio.com. Right in the middle of the screen is a big orange button. It says Get Your Questions on the Air. Go ahead and follow the instructions. Hit submit. Your question will pop up on our end, and we'll do the rest. But speaking of questions, let me throw it over to Jen and see what we've got. Go ahead, Jen.
Todd texted us this. If we take a reverse mortgage, are we able to sell the house later if we decide to move? We'll probably never move, but I don't want to be forced to stay either.
Hey, Todd, that's a great question. And you said something key in your question. Can you sell the property and move? And the answer to that is yes. There is no prepayment penalty on a reverse mortgage. You can sell the property, you can refinance it, you can pay it off in full and stay should you wish. So in that sense, you absolutely are not restricted. You'll be able to sell and relocate should you wish. Now, here's the thing. If you choose to move and make another property your primary, then that note can be called due because the reverse mortgage has to be on your primary residence. So don't think you're going to take a reverse mortgage on your primary residence and then go downsize and move into a condo and rent the primary out, because that's now no longer your primary, the condo is. And in that instance, you would be forced to pay the mortgage off. So, but in your question, you said, can I sell and move? And absolutely you can. There's no prepayment penalty. But I just wanted to throw that out there because a lot of people love the idea of taking the reverse mortgage and then later downsizing and turning the primary into an income producing property. That is not allowed. I hope that helps. Hey, Jen, throw me another question.
Roberto sent us this one. I've been RVing since the pandemic, and I'm ready to settle down in Texas. I haven't paid rent or had an address for 3 years. I kept a P.O. box in Florida for a mailing address, and my sister checks it for me. Do I have a shot at getting a mortgage?
All my exes live in Texas, and that's why I reside in my RV. Hey, Roberto, very, very cool. And I want to say, yes, this is a doable deal, and I'm going to tell you why. During the pandemic, Jen's back there, the face she's making, I wish you guys could see it on the radio. So during the pandemic, we were able to close a transaction for a couple that lived in their RV for over a year, and they had a fantastic time. They were locked down. They were frustrated. They were able to run their business over the internet, and it sounds like that's what you're already doing. They RV'd for a little over a year, saw the entire country, decided to relocate to Florida, and we were able to establish that during that time, their business income did not suffer. As a matter of fact, their business grew. It took some extra documentation and a little creativity, but we were able to get them approved for a primary residence. In this case, it was in Florida, but the same would apply in Texas. So great question, my man. And I would love to talk to you and hear about your adventures over the last year. What did you say, 3 years? Man, super, super cool. But yes, to answer your question, you should be able to be qualified for a mortgage. Extra paperwork, and we're happy to help if you need somebody. I appreciate that one. Hey, Jen, throw me another question.
Tabitha sent us this. So we tried to get a HELOC, but our bank said we have too much debt and our credit scores are too low, probably because of the high balances. We haven't missed any payments, but really want to pay some things off. Do you offer a lower credit score equity line?
Too much debt on my hands. What was that, Sticks? Too much time on my hands. Anyway, I apologize for the singing. I don't know what's gotten into me today. I told you I was highly caffeinated. So here's the thing. You're not alone in this, Tabitha. A lot of people are experiencing this exact scenario. The banks are increasing the credit score requirements for HELOCs, home equity lines of credit, and they're lowering the percentage of the value that they're willing to lend. So a lot of people who were going the HELOC route, in addition to the HELOC rates have gotten quite a bit higher than most people have expected. It's really, really interesting to see what's happening. So your scenario fits the bill for a lot of people. A lot of people are going through this. And the way the debt to income is calculated on the equity line is different than the rec refinance. So to answer your question, there's not a low credit score equity line. Our equity lines have a wider range of credit scores, so we might have a broader offering. But here's something to consider. The rec refinance, the debt to income calculation is done after the proposed debts are paid off. So you mentioned you feel like your score is pulled down because you have a lot of debt. Well, in the world of the rec refi, REC, reduce, eliminate, and consolidate, we're able to take those debts out of your debt to income ratio now. So if you're going to pay off a car payment and a couple credit cards, boat, whatever it is, we take that out of the equation and qualify you with the new mortgage payment. So you're paying off your first mortgage, and yes, most likely your interest rate is going up, sometimes significantly on the first mortgage, but the interest rate and payments comparably on everything else is coming down. So oftentimes there's a significant monthly savings. Not always. Sometimes it doesn't make sense. But if you've tried the equity line route and have not been approved, check out the rec refi. You may be surprised. Go to refi.com. Anybody can go there. It's an explainer video. There's a debt consolidation calculator in there. You don't have to punch in your email address or phone number. It's not one of those deals. It's out there for everybody to use and see for yourself if the rec refi makes sense. reCREFI.com. I hope that helps, and I'm always open to discuss specifics if you need more information. Just give me a call or shoot me an email and we'll set up a phone call. I appreciate that one. Thanks. Hey, Jen, throw me another.
Vince used the website. How fast can we get a mortgage? We found the perfect house and don't know where to start. We verbally agreed on a price, but the seller wants our approval before they'll write a contract. No agents are involved.
Hey, Vince, thank you for using the website. I'm super excited that you pressed the big orange button. But to answer your question, man, we can move as fast as you can. So I tell everybody we drive the bus, but it's your foot on the accelerator. And what I mean by that is if we can get the documents in and get your complete application in, you can have your approval in a couple hours. You know, let's say half a day to play it safe, but we're turning them in a couple hours. But it really depends on how quickly you can provide the documentation. That is if you want a bona fide approval. And I guess the hierarchy of approvals kind of go like this. Pre-qualification means that you just give somebody your information. Hey, my name's Vince. I make X amount a year. My credit score is this, and I've got about this much in the bank. And they'll say, okay, Vince, based on that information, you should be qualified, air quoting qualified, for a mortgage of X with an interest rate of Y. In approval, a pre-approval, your documentation is actually verified. You're uploading your bank statements. Somebody's reviewed your credit report, and they tell you that you are approved based on the documentation that you've provided. And then the next level is actually running you through the underwriting system. It's called AUS, automated underwriting, and it spits out either a conventional FHA, VA, USDA approval. And that approval says, assuming that everything in this application is accurate, and that's why we ask for the documents to review everything, this mortgage is fundable as one of these loan programs, then all you need to do is find a property, the property appraises, the property meets the guidelines of the loan program, and you're up and running. So if you want a bona fide approval and you can get all your documentations in the morning, it's not out of the realm of reality that you have a bona fide AUS approval by the afternoon to submit with your offer. And if you're looking for somebody right now, my hand is in the air. Guys, if you can hear my voice, my team can be your choice. Everywhere the radio show is, my team is as well. Everywhere but New York, that is, by the way. So, but Vince, if you are seriously in the need of something right now, just give us a call, and Jen will put you on hold. When we get off the air, I'll jump on the call with you, and we can get the process started. Guys, that's just one more example. Vince went out there and found a place in this market that he wants to make a move on. So I'm happy for you, brother. We're here if you need us. Guys, you hear the music? You know what that means? We have wrapped up another week of the Mr. Mortgage Show. Hey, Vince, it's perfect timing. If you need me now, I'm going to be off the air here in a few seconds. Guys, if you need us during the week, head over to MrMortgageRadio.com. That's MrMortgageRadio.com. One more time for the kids in the back, MrMortgageRadio.com. Otherwise, Jen and I will be back next week right here, same time, same station. Guys, have an awesome week.
That's a wrap. Join Mark Eitel next week for more thrilling, edge-of-your-seat discussions about real estate and mortgages right here on The Mr. Mortgage Show.